Hey everyone, welcome to Chart This with Dave Keller. I'm your host, Dave Keller. Happy Monday, October 21st. We're coming to you live here from a beautifully overcast and cool Redmond, Washington. I'm laughing at our first comment here during the live stream, welcoming me back with the red carpet, the red being the red in the markets. Thank you, Tony, for that kind welcome back to the show. Great to be with you here every market day after the close. We were down in Orlando end of last week for the Money Show. It was so fun to meet a number of you. Thank you guys so much. Those of you that said hello, it was really a pleasure to meet all of you and get to know just a little bit about who you are and why you're appreciating the content. Some great ideas about how we can make the show better. Really enjoyed talking with all of you. Hope you guys all had a safe trip home. We had a lot of fun at the Money Show. Had a couple presentations, including a 2-hour masterclass on different routines to follow. Also did a number of podcast interviews, talking with guys like Peter Schiff and Adrian Day, Mike Turner. It was a lot of fun. Some really thoughtful comments from some of those market practitioners. I just am getting the raw footage here today, so I hope to get those edited up and shared out with you in the form of our podcast. You can find all the episodes of our new Market Misbehavior podcast on our YouTube channel. We've got a playlist set up just for all of those. So look for those episodes to kind of trickle out through the course of this week and next as I can get to it. Today, certainly not a risk-on day and a lot of damage in the first 2 hours of trading before kind of a nice recovery going into the close. But overall, we're going to talk about a little more red than green. We'll talk about some of the individual charts, starting to break down just a little bit. And while, there are not a lot of things breaking down through significant support levels, there's certainly things starting to retract a bit from all-time highs. At the same time, charts like NVIDIA just continuing to move, as we like to say, onward and ever upward. So with that in mind, let's get to our market recap and focus on how things played out on today's trading. Looking at the S&P 500, you can see down 0.2%. The S&P closing just below 58.54. The Dow is down a lot worse, down 0.8%, 42,930, we'll call it. The NASDAQ composite at 18,540. That's down just 1/3% from yesterday's close. Look down, though, at mid caps and small caps. The small cap S&P 600 index was down 1.7%. So there's your first kind of thing to think about. Just focus on the 2-day preview chart on the left side of my screen here. So the left side is Friday's close, Friday's session. The right half of this little chart is today's session. So look at the S&P 500 with the big sell-off in the first kind of 2 hours from 9:30 to 11:30. Then kind of this nice appreciation to, again, close below Friday's close, but, still kind of moving higher through the course of the day. Compare that to the S&P 600 small cap index, which literally just trickled lower into the close, was down even more. So small caps down 1.7% today versus the NASDAQ up 0.3%. That's what a big NVIDIA rally will do for you, is that it's a big enough weight that it can push the NASDAQ 100 higher, while kind of the average stock was not particularly strong here. The VIX, not much of an upward move given the drop that we had in stocks today. And of course, you had a much bigger move earlier in the day, right? So the VIX did get above 19 earlier. It got up to around 1930. But by the close, almost a full point lower, down to around 1840, and that's where we finished today. So up about 0.4 from Friday's close. The VIX still remains below 20, so I would say that's still a low volatility environment. And I like to keep things simple until and unless, and it's more until the VIX pushes above 20. We're still in a low volatility, probably fairly constructive market environment. A lot of movements in a lot of other asset classes. We're going to talk a little bit about interest rates. We're going to talk about commodities and the currencies. We don't talk about those in every show because we tend to focus more on stocks and ETFs. But I would say a mindful investor, right? If you really want to be a holistic investor, you really need to think about whether or not you're buying individual stocks or just the broad S&P or NASDAQ or Dow or something. You want to make sure that you understand other things like the dollar, like gold, like crude oil, because these are all things, interest rates, because these are all things that certainly affect stock and index prices. Whether or not you understand the exact nuances or how they can impact different businesses. That's what I would hope you can improve on over time. But generally speaking, I think it behooves an equity investor to understand those other things and just reflect on how that might impact your portfolio, especially if you have a concentrated bet on a particular sector or theme. Some of those macro drivers could really make things change very quickly. So that's the long bond yield that we're looking at. You can see that it got up to almost 4.5%. We're finishing just slightly below that, but that's up a full percent from. Sorry, that's not a full percent. That's full 0.1. It's a 10% move. It's an improvement of 0.1 from yesterday. So not that bad. It's not a full percentage move. It's a tenth of a percent. But the long bond yield just below 4.5. The 10-year yield just below 4.2%. The 5-year point ended the day just below 4%. We'll call it 398. The dollar index did move slightly higher, about 0.5% higher. That's using the UUP, which is a bullish dollar ETF. To the commodity space, you can see a little bit mixed, right? Gold actually kind of flat. Did open a lot higher. The GLD did, but kind of came back, and as stocks sort of sold off in the morning, gold sold off as well, but did sort of hold steady from Friday's close. So essentially, no real change for gold. Silver was about 0.2% higher. Crude oil having one of the better moves, at least in the commodity space. And as you'll see in a moment, energy actually one of the better S&P sectors, but still a little bit down on the day. Bitcoin, Ethereum, and most of the other top 10 coins that are tracked on the Stock Charts platform all in the red today. Over the weekend, you can see Bitcoin actually was pushing back higher, kind of pushing back toward that 70,000 level. But as of right now, choppiness around the equity session, currently trending higher here in the last couple hours. And currently just below 67,800. Ether prices around 26.80. Both of those are down from Sunday's closing value. All right, looking at the 11 S&P sectors, you can see NVIDIA being up a couple percent really helped things because the technology sector, of which NVIDIA is one of the largest weightings, was up about 0.5%, right? The XLK is dominated by Apple, Microsoft, NVIDIA, and then a bunch of other things below that. So NVIDIA, a strong up day, making another new all-time high. That's helping technology be the lone green mark on a big pile of red sector returns today. Energy was number 2, still down about 0.2%, but not one of the worst places to be. Industrials and utilities and communication services all down about 1/3%. On the downside, REITs were the worst performer, down 2.1%. Healthcare down 1.2%. And consumer staples down 0.8%, about the same for financials and materials and consumer discretionary. So most of the 11 S&P sectors finished in the red today, to be clear. And as a reminder, as we're going through some of these different charts, as we our market averages and indicators, once we get into the chart portion of the discussion, put any comments, any questions you have in particular in the chat of wherever platform you're watching this. We're live streaming this on YouTube, on LinkedIn, on Facebook, on X, wherever you're at. I can see your comments right here, and I can pop them on the screen later when I have time to take a question or two before we wrap the show. Any of the questions we don't get to, we will put in the mailbag, and we'll hopefully do another mailbag episode Friday of this week. It's been a lot of fun to kind of take some of the great questions you've received and spend a little time answering them with all of you. So please make sure you drop questions as you're watching, as they come up. Our market trend model, which is something that we report on every week to our premium members, we kind of start our weekly report called our weekly flight plan with a discussion about the market trend model, because that really informs a lot of my own thinking about positioning and about risk assessments and how, whether I'm looking for new ideas or whether I'm trying to lighten up and raise cash. The market trend model for me is a big part of just how to approach a given week. And as of Friday's close, and I updated every Friday close once a week, market trend model bullish on all time frames. My main model uses the S&P 500, and we can see short-term, medium-term, long-term, all bullish. And for me, short-term is a couple days to a couple weeks. Probably a couple weeks is fair. Medium-term, a couple months. Long-term, a couple years. That's a total generalization, but it's kind of how I would think of those time periods. So for now, it just tells me that the market remains in a position of strength. We'll see through the course of this week, and I would argue with not a lot of economic data coming out or set to be reported. This is kind of a quiet period going into the elections in a couple weeks, and then the Fed meeting in November. I would say its earnings this week are kind of the besides other big news event like macroeconomic news and election news, whatever else might drive things, it's really going to be about earnings and what sort of updates we get from companies reporting this week. And certainly some of the macro changes that we're starting to observe, like the dollar popping higher, gold making new highs, crude oil prices coming down, interest rates pushing back higher, seeing how some of these companies are projecting those changes as potential impacts to their business going into the beginning of next year. I think that's what a lot of investors will be thinking about. Boy, as the day went on, Nvidia just kept getting brighter and brighter green. I guess I didn't realize how far it had finished to the upside, finishing around 143.70, and that's up over 4%. So while the market was kind of flat to down, Nvidia distinguishing itself with a nice up move. Netflix up 1.1%, Apple up 0.6%. Only two of these stocks were down. Tesla down 0.8%, Meta down about 0.25%. Tesla has earnings this week, and a number of other mega cap names as well. Bulk of the S&P 500 are reporting this week and then next week. So quite a few earnings releases to kind of debrief on as we go through the course of the show this week. But I would tell you what's interesting. I mean, just think about the relationship here, right? Here are the 11 S&P sectors. How many of them are up on the day? 1. How many are down? 10, right? So 1 out of 11 finished in the green. Now keep that in the back of your mind as we look at this next one, which are the Magnificent 7 kind of leading growth names. How many of these out of 8 were in the green? And it's 6 out of 8, right? And so there's why the benchmarks were up or flat to up a little bit, while the major sectors were all down, almost all down, because the biggest names were actually up. And this is that weird kind of conflicted environment we live in, where a small number of stocks have such an outsized impact on our benchmarks. If you just look at the value of the S&P or the NASDAQ 100 and think that's the market, it really isn't. I mean, while that is, if that's your passive investment, if that's your core position in like the spiders or something, yes, that's kind of the market. But that index is really dominated by a relatively small number of names. And so owning individual stocks, you may have a completely different experience on a day like today, because the indexes are kind of artificially positive because of the strength in stocks like Nvidia. It doesn't take many of these being in the green in a pretty big way, and it can dramatically change how the benchmarks look. All right, let's go to the market carpet. And by the way, I just finished a video not too long ago for Stock Charts TV, the Stock Charts YouTube channel. I'm doing a weekly show every Monday now for Stock Charts TV. And I did an episode just particularly on this market carpet visualization. So make sure you check it out there. I don't know if it's posted quite yet, but probably will be before the end of the day here today on Monday. But I hope you can check it out. If you appreciate what we talk about with this heat map, I go through a couple more examples, some different ways to use it, just ways that I think a visualization like this can really help inform your process and at least give you a really good starting point with which to go through a deeper analysis. As a reminder, there are 3 general things I do when we're looking at the heat map. And here we're just looking at today's market activity from Friday's close to Monday, today's close. Number 1, what's your overall impression as you sort of take a step back anecdotally from the screen and sort of take a look at the entire landscape? I'm seeing a lot of neutral and a lot of red, generally speaking, right? And the average sector is kind of neutral to red. I'm seeing random little pockets of green, but not much. So overall, this certainly feels like kind of a down day, right? In terms of just the number of stocks that are not up at the moment. Number 2, look at what I call the big dogs, the big charts, the big boxes, which represent the biggest names. What did they do? And again, to reiterate what we mentioned earlier, the reason why the benchmarks are not down a lot more today is the fact that you can see that the biggest names were either flat, slightly higher, or a bunch higher in the case of Nvidia. So these biggest names holding up okay is what makes the benchmarks look a lot better than they would if all of these were more heavily weighted in the index. So that's number 2. The biggest names did okay today. Final, any specific themes or ideas that jump out at you? And on a day like this, when it feels like most stocks are kind of down, flat to down, I like to look for outliers, right? What was actually up while everything else was kind of down? What actually gained some ground while the average stock was actually pushing lower. Immediately, outside of some of these growthy sectors we've talked about, advanced auto parts, which has been one of the worst performers here year to date, certainly since a peak in March, actually popping higher about 3% today. Still, I think a lot to prove there, but kind of working. Expedia actually made a new 52-week high today. Boeing actually having a nice bounce off of the lows as well. Alaska Airlines, the airline space has been pretty good. Alaska in the last week has been pushing new highs up another 2.5% today. In the energy sector, SLB actually bouncing a little bit higher, although I would say the trend is still sort of primarily down for those areas. And then in the financial sector, CBOE, which not quite breaking out, just maybe getting close to pushing to the upside. So on a day like today, think about what the market did in terms of the benchmarks, in terms of the average return, and then look for things that did the opposite. And that can a lot of times help you identify some company-specific opportunities. And some of those ones that I just mentioned are some of the ones that jumped off the page at me. And by the way, I was just going to say another way to think about it. Here's the SPY, and I'm just bringing this up to show that the S&P 500 was down 0.15%. The RSP is an equal weighted S&P was down 0.82%. So that gap from down 0.15 to down 0.82 is the when you equal weight them and take the mega cap impact away, the indexes were down a lot more than the high level number that's reported in terms of the S&P and the NASDAQ. All right, I think I made that point enough. Let's continue on and look at a bunch of charts here to finish off our show. We're looking at the S&P 500 daily chart. If you've been following the show and following my work, you remember this sort of accelerated trend line that we put on the chart last week. The main trend line we've been tracking on the S&P 500 is taking the early August low, the low from the second week in September, and kind of projecting that forward. That's that dashed blue line that you see. Now, what happened was a couple of weeks ago, we started to make a higher low, but far away from that trend line. And that happens when a market starts to accelerate, which it certainly feels like we have. When the pace of the incline increases, you all of a sudden get further and further away from your trend line. So you have two choices. Number one, have a trend line that is less and less actually tracking the price action, or start to draw trend lines of an increased slope to match the new pace of the market. So I have the original trend line still on here because I still think that might be an important one to watch. But I drew a new trend line from the low second week in September, the low from earlier this month in October. That lines up pretty well with the trading range that we experienced today. So that's kind of the new shorter term trend line, just to track the pace of the trend. And if we break it, I don't know if that's the end of the world, but it certainly would tell me that whatever pace of the move was happening, something might be a little bit different. We did trade below there during the day today. We closed right about at the trend line support. So going through the course of this week, my main question is, does that level hold? And if we would break that, that's where I would start to look down to some of these further levels right around this 5650 to 5670 range. That includes the breakout level from July and August, which often becomes support, the 50-day moving average, that trend line we talked about, the early October swing low. All of those are kind of right in that range, which means as long as we hold kind of 5650, those levels in some way are holding as support. But if we would break those, that's kind of the line in the sand where I would say, okay, hold up, something's different. We need to revisit our general thesis there. Continuing on here through some other charts, breadth analysis is a big part of my process. And I would say with, what we saw today, breadth indicators, overall still holding up quite well, right? The advanced decline lines certainly came off a bit today because at one point it was a 90% down day, at least in the small cap space and maybe the mid cap space. I think it came up a little bit as things sort of bounced off of that early, low from earlier in the day. But overall, breadth conditions did come off a bit. And I want to point out that with today's close, we're back below that threshold of 75% that I track, which is where when this percent of stocks above their 50-day moving average for the S&P 500, when it gets above 75%, it's kind of a euphoric sign where it feels like kind of almost everything's going up. And when we get back below 75%, that at least, indicates kind of a brief pullback, and at worst tells you we're at the beginning of some sort of corrective move. So we did come below that extreme level on today's drop. And again, this is one of those where the S&P was down slightly, but a lot more stocks broke down than the index, I think, reflects it. And that is actually pretty common at a major market top. where you have the market pushing generally higher, but breadth conditions start to rotate lower. And because a lot of things sort of already break down before the major benchmarks start to come down, it's all a question of market caps and whether investors are getting defensive and what types of names they're owning. But if a lot of speculative positions start to be unwound, the breadth indicators start to rotate lower. The other thing that I was just noticing when I was looking through that this weekend, this is another one where you have a potential bearish divergence here with higher highs in price late September to now mid-October, lower peaks in the amount of stocks above their 50-day moving average. So this last push higher now in mid-late October on weaker momentum or weaker breadth, and that's usually not a healthy sign for the market. High yield spreads and credit spreads in general are remaining fairly narrow. Now, this is not updated for today's close just yet. This is as of Friday's close, but I did want to point out, because I had some questions on this at the Money Show. Credit spreads, to summarize, are basically a measure of risk, I guess, is how I would think of it, because it's what sort of tells you where high yield bonds are being priced. And that is in a lot of ways on bond investors and their assessment of potential risks for these companies going forward. So when spreads are very narrow, which right now they're literally, as of Friday, at the narrowest level they've been in years, that tells you that the bond markets are pricing in very low risk. They're basically seeing conditions as pretty good. They're seeing these junk bond issuers as relatively stable compared to history. And as a result, there's no real need to be concerned. You see a spike in high yield spreads, or what's called a widening of credit spreads. That would tell you bond investors are seeing, elevated risk. And, for equity investors, that's usually a good warning sign. You might want to lighten up a little bit. But we see spreads remaining fairly narrow as of Friday's close. We'll see as this week plays out, as we get these data points built up through the week, if that's changing at all. And the VIX overall back below 20. And these are plotted upside down just to match more of the trend in the S&P. When spreads are narrow, when volatility is low, stocks tend to be trending higher. So what you're looking for on this chart is volatility to widen or volatility to increase, spreads to widen, meaning bond investors are getting a little more nervous, and that usually would coincide with stocks starting to rotate lower. So let us see if we see that change. As of Friday, really no cause for concern just yet. Now, in the commodity and currency spaces, there are some changes I think you want to be aware of if you don't follow those markets very quickly, because what I would tell you, no matter what you think about the impact of these broad market indicators or these other asset classes, they're certainly changing quite a bit. And I think that's what's worth noticing here. The dollar, which was weak through July, August, and September, is now strengthening. And you saw the breakout above trendline resistance beginning of October. And it's just been pretty much a consistent rally beyond there. I would certainly be concerned, particularly with multinational companies. If we see a big increase in the value of the dollar, what that can do is start to make their non-US revenues a lot less valuable, because they have to convert all of those yen and liras and whatever. Lira is probably a horrible example. Pesos and francs and whatever currencies that they're earning money in back to US dollars. So if the dollar is stronger and stronger, their non-US revenues are just less valuable in dollar terms. And so that, it's still early days on that, but that as an emerging trend could be a real issue through the course of the fourth quarter. And that's when you'd start to see companies having to adjust for that going into the beginning of next year. Gold prices continue to go higher. This is on Friday's session where gold closed to 2730 for the first time. So gold continued to go higher despite the fact that the dollar is stronger. And what I wanted to show here is just to remind you, a lot of people would say, if the dollar's going up, then gold can't go up because they tend to be inversely related to one another. And generally speaking, you're right. Generally speaking, when the dollar's getting stronger, gold is usually getting weaker, and the opposite. You can see that like November, December of 24 with the dollar going down and gold going up. It's kind of the normal relationship, but it doesn't always happen like that. And just because the dollar is going up, that doesn't mean, well, gold has to go down. It doesn't. And in this case, you actually see the dollar and gold trending higher. So I would say think less of those relationships as hard and fast rules and more general guidelines that can and often are very, very fluid. Interest rates popping higher as well. And so again, from the beginning of October to today, we're seeing big changes. The dollar was weaker. It's now stronger. Gold continued to strengthen. That actually hasn't been changed. That's just continued to go higher. Rates have been coming down pretty consistently from late April to mid-September, now going the other way. The 10-year yield's almost to 4.2%, and that's up from around 3.6% just about a month ago. So you're seeing the 10-year yield pop up quite a bit. And again, higher rates are certainly not something that I would argue the market is kind of pricing in there. It's sort of thinking more rates coming down as the Fed is lowering the short end of the curve. But for now, the 10-year yield popping higher. Looking at offense over defense, I just want to point out the difference between the equal weighted version, which did make a new 52-week high here in October, versus the cap weighted version, which has not. The cap weighted version is subject to some of those big companies like Amazon, Home Depot, Tesla being huge weights. The equal weighted version I like a little better because it's just a pure look at things you want versus things you need, or offense versus defense. This is very much favoring offense. In this kind of part of the cycle where you see the market making new highs, it's been a pretty consistent bull market in 2024. Look for this sort of ratio to turn down. The last time we had a major downturn was at the end of July, mid-July, which told us, okay, hold on, things are starting to get defensive. Look for that sort of change. And I would say as of today, not seeing it yet. We'll finish off looking at a couple stock charts, and then I do see some questions. I'll try to get to one or two before we wrap today's show. Boeing gapping higher, one of the top performers in the S&P 500 today. Local company, obviously, here in the Seattle area, gapping up just over 3% today. What I wanted to point out in a chart like this is don't ever get too drawn into a stock being a big gainer on one individual day. On a day like this, I think it really helps to take a step back, either physically or mentally, and just think about the overall trend. Even though we do have a nice gap higher on Boeing, we're coming off of a new 52-week low about a week ago, right? We're still sitting below, on a closing basis, below two downward sloping moving averages. So while that gap higher is encouraging, I would need to see more improvement. Things I would be looking for: a higher low, right? It's putting in a low around 150, 155, really distinguishing itself from the October low. The moving average is starting to slope higher, particularly the 50-day, which is still going down. The RSI going above 60 because it's been below 60 this whole time because we've been in a primary downtrend. Wait for the trend to change. Wait for signs that it's not just a one-day thing, but a broader improvement. For now, I see a stock gapping up to a downward sloping 50-day moving average. I remain skeptical of a chart like that. What you want a Boeing to do is kind of what Lululemon did, right? Here's like that gap higher for Lululemon in mid-August. I would argue at that point, still quite a lot to prove. We traded up to a declining 50-day moving average. This is where things start to get interesting. We make a higher low than the August low. We then break above the 50-day. That becomes support. Now we're starting to see accumulation. Now we're starting to see buyers coming in on the dips. Instead of selling the rips, we're buying the dips. This is more of a constructive, what I would call a period of accumulation. The RSI breaking above 60 as we're pushing to a new swing high above 280. That is a chart, I would say, in an improving structure. So Lululemon, another stock up today. And I would say this one, a really nice developing uptrend, and a chart that I'd probably consider more optimistic than not. A couple names breaking down. I just wanted to highlight Home Depot is one, down about 2%. And again, kind of like Boeing flipped over. It's one day, so I don't want to write off Home Depot as a good idea just because we came off a little bit. I would look to see at some point we'll have another rally. Do we see a new high or not, right? Does it try to make a new high and fail to do so? If we get a lower high after this, that would be a cause for concern. For now, could be just a normal pullback within this general uptrend. But think about what the chart of Home Depot would need to do for you to think of it as something different. Lennar and the other home builders getting dinged today. I would say rates going higher, certainly probably part of that theme in terms of the home builders coming off today. Lennar in particular was down 4.4%. What concerns me about this chart is after the new 52-week high, third week in September, we then have a lower high in late September, early October. We've kind of retested that level here. So now we've kind of stabilized. Today, we closed just below an upward sloping 50-day moving average. 177 or so is kind of the mid-October low. That's kind of the low from early September. We had that hammer candle right around that point, mid-September as well. So we're kind of nearing that level where you might expect some short-term support. That's where I might set an alert, because if we break that, that would tell me maybe home builders are breaking down a little bit more. And what you want to avoid is something like Builders First Source, ticker BLDR. This is a building materials name in the industrial sector, kind of similar to that Lennar chart. We made a new high in September, then some lower highs, and now we're breaking down. But the challenge is Builders is actually breaking to a new 1-month low, right? So again, still more to prove, I think, in terms of distribution. It's not an end of the world breakdown, but it's certainly not going up anymore. And so recognizing that that is starting to change as the chart is down 5% today, pretty important. All right, I appreciate so much all of you guys with the questions. Let's think about some of these questions that are coming in. Edward, thanks so much for watching via X. You asked, how does Tesla look ahead of the numbers? Yeah, they're reporting earnings later this week. Let's bring up the chart of Tesla, because I actually didn't show it today. Tesla, here we go. Tesla is reporting, I think it was on Wednesday. I had the list of S&P names and when they were reporting. I had it down here. Let's take a look. Yeah, Tesla reporting on Wednesday, and I think it's after the close. After the close is correct. So here's the problem with Tesla. I would say if you have an option to say neutral, that's what the charts say to me, and I will tell you why I would answer neutral. Given bullish, bearish, or neutral, I would say at this point it's neutral. What does Tesla have going for it? Well, overall, I would say there's been kind of this nice recovery off of the April low. And I would say that, we're not really breaking down any significant support level just yet. However, on the downside, we did not get to a new high here in late September. We sort of failed to get above that July peak. We've gapped down in the last week and a half. That was after the robo-taxi event that, I guess went fine. The technology was interesting, but investors took that as kind of a negative, that there weren't a lot of specifics or, I guess, believable timelines about when some of this stuff would be available. And so the lack of a low cost, more accessible Tesla for the common man, as opposed to the plaid Model S's that I've seen driving around the Seattle area. I mean, investors not really taking that as a positive. Earnings could, as always, provide a catalyst. And I would say Tesla right now is in kind of a neutral no man's land, right? We've gapped below the 50-day moving average. So I would say getting above that gap level, at least in the short term, would be bullish. The 200-day is not too far below current levels, just above 200. So I think the 200-day is sort of my lower end, tactical support. So one of those is going to break. I mean, most likely around earnings, whether this gets positive or not. This is the type of report where I would be very happy sitting on my hands and just waiting to see which way this resolves. And then the day after that earnings report, Thursday, I think is going to be a key session for Tesla, because that's the follow through, right? We're going to get a gap after the close in the after hour session as investors kind of reassess where to value a stock like this after their earnings report. I'm sure there'll be a lot of questions about, following up from that robo-taxi event. And so maybe they fix some of those errors about trying to be a little more specific about, expectations, maybe talk a little bit more about the low priced option that's allegedly in the works. But I would say from a technical perspective, look to see where we break on Thursday and see if there's that follow through of additional, momentum after that gap. That's how I would think of that for sure. Great question. Thanks for asking about that. Here we go. Chaos and characters that I don't understand. I'm so sorry. I can't read the rest of those, but watching on YouTube, you could add Broadcom and Taiwan Semi to your Magnificent Seven and Friends list. I don't know. I'm not a big fan of changing that list too much, but I get the argument. I would say very quickly that becomes the semiconductor. It's like Magnificent Seven Semiconductors and Friends at that point. So I don't know if I would be really into that. But I get the idea of, in terms of, bellwether leadership names. Yeah, you would argue both of these charts, if you put Taiwan Semiconductor and Broadcom in that Magnificent Seven and Friends, and all of a sudden it's 10 names that are pretty sort of mega cap, big dominant names. These would arguably be the two strongest charts out of that group at this point. So I get the idea. Maybe the Magnificent Seven, maybe the era of the Mag 7 is over. We are starting to see quite a bit of differentiation between names like Alphabet, which have looked a lot worse than names like Meta. So at some point, we'll sort of rotate that back. And by the way, I saw your Education for All. I say thanks. I'm learning a ton today. The characters are chaos in Chinese. I'm guessing the Chinese script, and then Japanese kanji. Thanks so much for sharing that with me. I actually didn't know that. I appreciate that so much. All right, last question, and then we've got to wrap it. NASDAQ Poppy, love it. I think with the Ronaldo, which my son would love. Volume is collapsing. I don't know how anyone can be bullish right now. I don't disagree with you. I would say I do know how someone could be bullish right now. And the reason is because the trend overall remains quite strong, right? And as long as the market keeps making higher highs week over week, I'm probably going to still be fairly constructive and want to be as all in as I can. The way I would think about volume, and I would say particularly with the S&P, is look at Chaikin money flow. And I have done some videos on that in recent weeks. If you go to my YouTube channel, if you're not watching it on YouTube, look at the episode show that I did, I think maybe last Friday, on the Chaikin money flow indicator. But this looks at volume, not just looking at daily volume readings, but more looking at the trend in volume. And this is the chart that I used in the video, so I won't steal the thunder of that video. But I would say the fact that we're having a potential divergence with the market making new high through the course of October on weaker Chaikin money flow readings often is a great leading indicator of a pullback phase. And we've seen that 3 times in the last 2 years, and it's worked out particularly well. Folks, that's it. I want to thank you guys so much for all the thoughtful questions. Thanks so much for putting them in the chats wherever you're watching our show. And thank you for tuning in from the different live stream locations. Again, and thank you, those of you that introduced yourself at the Money Show. Great to put some faces behind the names that I see watching the show every day. I can't thank you enough for the kind feedback, the kind words you've given me on the show. Always looking for ideas about how I can improve this and help you make sense of the markets using the language of technical analysis. If you have suggestions, just put in a comment on my YouTube video primarily, and I'll make sure that I review those. By the way, if you want to learn more about this sort of approach, go to my website, marketmisbehavior.com, and particularly if you want a free course on how to apply these sort of lessons using what I call behavioral investing tips, go to marketmisbehavior.com/free course. And I hope you won't be disappointed. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Have a great night, everybody.